Have you ever wondered why the advice you follow from wealthy role models so often fails to build the same results for your own money? During World War II, military engineers examined returning bomber planes covered in bullet holes along their wings and fuselage, immediately concluding that they should reinforce those heavily damaged areas with extra armor. But they were overlooking a fatal detail. What about the aircraft that never made it back to the runway? A mathematician named Abraham Wald stepped in and pointed out the fatal flaw in their logic. The bullet holes in the surviving planes showed where an aircraft could take hits and still keep flying, while the planes struck in the engines and cockpit were resting at the bottom of the ocean. To protect the fleet, engineers needed to put armor where the returning planes had no damage at all. This historical breakthrough introduced the world to survivorship bias, a mental shortcut where you make critical decisions based entirely on visible success stories while completely ignoring the invisible failures. In the world of finance, this creates what analysts call a silent graveyard, a massive collection of forgotten businesses, failed investments, and bankrupt ventures that leave no public trace. When you look at wealth creation through this distorted lens, your understanding of how money grows becomes dangerously skewed. When you attempt to grow your wealth by copying the exact strategies of today's celebrated financial giants, you are often looking only at the bombers that made it home. This miscalculation leaves your prosperity vulnerable to the exact same hidden strikes that wiped out thousands of silent investors before you. This is educational content only, not financial advice. By relying strictly on visible triumphs while ignoring buried losses, your financial choices become guided by incomplete data rather than actual market probabilities. Financial marketing thrives on this exact statistical fallacy to attract your hard-earned capital. Investment firms, fund managers, and financial media routinely highlight top-performing assets while quietly liquidating underperforming products from their official records. By presenting only their winning streaks, they present a polished story of continuous market success while burying the losses beneath the surface. This selective reporting builds a false sense of security around complex investment vehicles. When you are exposed exclusively to winning outcomes, you naturally overestimate your chances of success and end up taking on massive, uncalculated risks with your savings. Consider the pervasive cultural myth of the college dropout tech founder who starts a company in a garage and becomes a multi-billionaire before turning 30. Society fixates on figures like Bill Gates, Steve Jobs, or Mark Zuckerberg, framing their unconventional decisions as a guaranteed blueprint for building extraordinary wealth. This dramatic narrative creates a powerful emotional pull, tempting you to believe that extreme risk-taking and pure ambition are all it takes to secure your financial future. You might feel urged to pour your life savings into speculative projects or unproven businesses, convinced that the potential reward far outweighs the danger to your prosperity. While these famous dropout stories capture our imagination, relying on extreme outliers hides the true risks lurking behind the curtain. Beneath those few household names lies an ocean of forgotten founders who took the exact same risks and lost everything. Look beneath the hood of venture capital, and the true picture of entrepreneurial wealth emerges. Imagine a line of 100 hopeful founders launching new business ventures today. To break this down simply, out of those 100 companies, 90 will quietly fold and lose everything within a few short years. 9 will barely scrape by, returning just enough cash to cover their initial expenses, while only 1 hits the massive jackpot that makes headlines across the globe. When you base your financial strategy solely on the lessons of that single runaway winner, you are ignoring 99 other outcomes. The vast graveyard of forgotten startups holds crucial details about market risks, poor cash flow management, and bad timing. Yet those stories are almost never published in business bestsellers or shared on podcast stages, leaving your view of building wealth severely warped. Treating a statistical outlier as your standard roadmap to prosperity is one of the most dangerous moves you can make with your money. Phenomenal market success often hinges on unrepeatable macroeconomic conditions, specific regulatory environments, and sheer historical luck that cannot be duplicated. When a single, wildly lucky entrepreneur attributes their fortune entirely to working hard or taking massive risks, they are overlooking the millions who took the exact same risks and went bankrupt. If you blindly copy the aggressive risk-taking habits of a rare financial survivor, you expose your hard-earned capital to total destruction without the unique safety nets or structural advantages that kept them afloat. Sustainable wealth building requires understanding probability rather than betting your financial future on exceptional anomalies. Relying on an extreme outlier as a blueprint means setting your expectations against a lottery ticket rather than a proven, repeatable system. While relying on individual outliers creates dangerous blind spots, this exact statistical illusion is systematically engineered on a massive scale across the financial industry. Consider how Wall Street investment firms package and sell their track records to everyday investors looking to protect their prosperity. An asset manager might launch 30 different experimental mutual funds quietly behind the scenes, using aggressive or niche investment strategies. By pure mathematical chance, 3 or 4 of those funds will post extraordinary returns over a 5-year period, purely through lucky market swings. The investment firm then aggressively markets those top 4 performing funds to you, featuring full-page advertisements, highlighting 5-star ratings, and beating the broad market indices. You are shown stellar charts and impressive returns, making it look like the fund managers possess an uncanny ability to navigate market cycles. What you never see in those shiny brochures are the 26 other funds that flopped or lost millions of dollars along the way. This creates a deep distortion in historical performance data through mutual fund liquidations. When an underperforming fund hemorrhages cash, the institution simply quietly closes it down or merges its remaining assets into a better performing fund. Suddenly, the dismal track record vanishes from the official industry databases, artificially inflating the average historical return of all active funds in existence. When you look at the remaining financial landscape, you are looking at a carefully curated lineup of survivors, giving you a false sense of security about active fund management. You might allocate your savings into a top-rated fund, expecting consistent market-beating performance, only to watch it revert to the average or fail once luck runs out. Recognizing this artificial inflation protects your money from being trapped in financial products designed around erased histories. Erasing bad track records creates a powerful illusion of expertise, but the deeper hazard lies in how risk itself gets redistributed between money managers and your personal portfolio. Inside the sleek marble-lined towers of institutional finance, this dynamic creates a dangerous setup known as asymmetric risk, a scenario where the potential reward for one party vastly outweighs their risk, while you bear the hidden downside. Fund managers collect massive management fees when their aggressive bets succeed, enjoying life-changing performance bonuses. If those high-stakes bets fail, the manager simply closes the fund and moves on to launch a new one, while you absorb the full 100% loss of your invested capital. When you evaluate financial products, you are often looking at a landscape carefully curated to show only the winning funds that survived this high-wire act. The dozens of failed funds that blew up along the way are quietly erased from marketing brochures and prospectus documents. This polished presentation gives you a false sense of security, making extreme risk look like standard, reliable performance. This exact illusion has taken on a new, high-speed life in the era of social media, where day trading gurus showcase luxury sports cars and claims of overnight fortune. These influencers flood your feeds with screenshots of massive single-day option gains, urging you to copy their precise trading strategies. What they rarely disclose is the basic math behind their public parade of success. If thousands of individuals execute reckless, high-leverage trades every morning, pure probability guarantees that a small handful will achieve extraordinary short-term returns. Social media algorithms selectively amplify those rare winners, transforming statistical anomalies into viral role models. Meanwhile, the vast majority of followers who lose their entire accounts fade into immediate silent obscurity. While feed algorithms push those winning trades straight to your phone screen, They systematically hide the trail of destroyed accounts that made those rare wins possible. To see how easily pure luck gets mistaken for legendary skill, imagine a giant coin flipping tournament with 10,000 participants. If everyone flips a coin 10 times in a row, basic probability tells us that about 10 people will flip heads every single time. Those 10 survivors naturally feel like master strategists who have cracked the code of chance, and they might even start selling courses on how to flip heads. What you do not see in that spotlight are the 9,990 participants who flipped tails and went home empty-handed. When you evaluate a strategy based only on the 10 people standing at the finish line, you fall into the trap of confusing simple random distribution with genuine repeatable skill. This blind spot becomes devastating to your long-term prosperity because it masks the true mathematical impact of catastrophic loss. When you only watch the survivors, you forget that losing 50% of your portfolio requires a 100% gain just to get back to where you started. A single wiped-out account destroys years of hard-earned savings in a matter of seconds. The emotional toll of chasing these survivorship mirages is often far heavier than the initial financial loss. Watching others appear to effortlessly multiply their money pushes you to take reckless risks with your own hard-earned savings, leaving you vulnerable to sudden economic shocks that can permanently derail your family's financial security. Protecting your wealth requires looking past the polished trophies of lucky survivors and examining the dangerous, invisible wreckage left behind. Imagine picking up the morning financial news and seeing that a legendary billionaire hedge fund manager just bought millions of shares in a struggling biotech firm. You might feel an immediate urge to follow suit, allocating a chunk of your hard-earned savings into the exact same ticker symbol to ride the coattails of a proven market titan. This impulse sits at the heart of one of the most tempting traps in personal finance, where everyday investors attempt to clone the moves of famous market survivors without seeing the broader board. When quarterly regulatory disclosures known as SEC Form 13F filings become public, financial media outlets trumpet these stock picks as guaranteed playbooks for building wealth. Yet what you see in those news headlines represents only a tiny, isolated snapshot of a massive, multi-layered financial strategy. The public sees the high-profile buy order but remains entirely blind to the off-balance sheet protections, private equity stakes, and massive cash reserves holding up the rest of the fund. To protect your prosperity, you must recognize that copying a survivor's portfolio without knowing their entire balance sheet is inherently dangerous. A billionaire who allocates $500 million to a speculative, high-risk startup is risking less than 1% of their total fortune, meaning a complete loss will not alter their lifestyle or solvency in the slightest. If you put $50,000 into that exact same asset, you might be risking half of your net worth on an asymmetric bet that your personal finances simply cannot survive. Timing and risk controls create an even wider gulf between the billionaire survivor and your own brokerage account. By law, major funds report their holdings up to 45 days after the quarter ends, meaning you are acting on stale financial information from weeks in the past. During that multi-week lag, the hedge fund manager may have already sold their position, secured offsetting options to hedge against losses, or restructured their portfolio entirely while you were just getting started. Because delayed public reports completely obscure real-time risk management, blindly mimicking institutional holdings usually results in buying an asset right as the original smart money is preparing to exit. The long-term consequence of this systemic information lag is a predictable transfer of capital from retail investors to institutional players. Over decades of market cycles, millions of individual savers repeatedly buy into surging assets at peak valuations because they are evaluating past performance rather than present risk. This cycle causes structural drag on personal wealth, leaving everyday portfolios vulnerable to sudden market shifts while short-term market headlines move on to the next overnight success story. When financial markets undergo sharp corrections, those who followed survivor portfolios without institutional safety nets absorb the full impact of the collapse. While major funds utilize sophisticated hedging mechanisms to cap their downside, individual accounts experience direct, unbuffered losses that can take years or even decades to recover. This persistent gap between theoretical survivor returns and actual investor results permanently impairs the compounding power of everyday wealth. The human aftermath of chasing these visible success stories is often felt far from Wall Street trading floors. Across the country, families who risk their life savings on high-profile stock picks or hyped venture trends find their long-term security derailed in an instant. The dream of accelerating financial independence transforms into real stress over retirement timelines, college funds, and basic household stability. This quiet financial damage reminds us that true wealth preservation relies on personal risk tolerance rather than someone else's public scoreboard. Experiencing a sudden 40% drawdown in your portfolio creates an emotional burden that no news article or online guru can fix for you. Protecting your prosperity requires honoring your own financial timeline rather than risking your future on the high-wire strategies of market survivors. Looking at the broader historical record, academic studies analyzing decades of market data consistently reveal that chasing top-performing funds and celebrity stock picks underperforms a simple, diversified strategy over long periods. This educational insight highlights the fundamental lesson of survivorship bias. Building lasting wealth is not about finding the rarest winner in the room, but about avoiding the hidden risks that quietly destroy ordinary portfolios along the way. This is educational content only, not financial advice. When you shift your perspective to study the hidden graveyard of financial failures rather than just the visible winners, your entire approach to growing wealth changes. Ever since mathematician Abraham Wald analyzed bullet holes on returning aircraft in New York back in 1943, clear thinkers have recognized that ignoring invisible losses creates fatal blind spots. In modern markets, recognizing survivorship bias means you stop chasing extreme outliers and start building a resilient strategy based on proven, repeatable probabilities. This is educational content only, not financial advice. When you look past the polished success stories on your screen and guard your money against the silent traps beneath the surface, you secure your prosperity and take true control of your financial destiny. If you want to stop trading time for money and start building real wealth, hit subscribe. We break down exactly how. If this video helped you, hit like, share it with someone who needs to hear it, and drop a comment below. What's one habit you're changing to protect your prosperity? If this helped you, go check out another video on our page next.